I think we've been for the last month, because if you really look at the performance of equity markets or the S&P for the last month, it has been side trading. So there was this big shock going down, then there was this big strong rebound, and for a month it's sideways. So I think we are now in a wait-and-see mode. Most of the macroeconomical news has been in the market, and obviously they are terrible, but everything that is being done by the policy mix between fiscal measures, which is equivalent to 6% of GDP, and the monetary policy side, which is 18% of the GDP, should also have an effect on the economy at the later stage. So I think it was very much Wall Street against Main Street. Now it's a sort of stabilization, and the trend of the data that will go out will be perhaps more important than the level, because the level is already in the data.
Can I ask you about stimulus here? The market yesterday seemed to bounce despite the negative news on jobs, because there was once again the suggestion from President Trump of even further fiscal stimulus at this point. How are you trying to take advantage of the market's belief that there is going to be round after round of support?
So I would say we try to construct in our asset allocation a sort of barbell strategy. So we are going into certain risky assets, typically investment-grade credit, obviously because of central bank support, but also because they have an attractive carry. We are going into some part of the equity, like a quality growth equity we quite like, because they would be resilient to a market shock. We also go to emerging market. We believe that there is a valuation which is interesting and liquidity is getting better. In counterpart, we also have some defensive plays, such as currency which are defensive, like USD, Swiss franc, yen, gold. So and doing some tail hedging with some out-of-the-money options.
Fiona, I'm a sensitive creature. I haven't got a very thick skin, but I want to know about the market sensitivity and how thick-skinned they are going to be towards the next quarter's data, because I think on an employment front, on a GDP front, or on a sentiment indicator front, you name it, house building, they are going to be horrendous, negative double-digit figures across the board. Is the market going to be sensitive to this kind of data, or is it saying, do you know what, I've seen so much bad data now, I'm trying to look beyond it?
I would say that the market for the moment is quite balanced between a certain bullishness and bearishness. The numbers of bull players and bear players are quite aligned. The beta, for example, for multi-asset funds remain quite low. Systematic strategy doesn't show that they would have to sell too much or buy too much. So it is not that the market sentiment is more neutral now and more balanced than it was a few months ago. So although we expect some volatility, and we think that this will be the name of the game for the months coming out, between data going out which are better than expected or worse than expected, and I said here the trend will be very important. We believe that we won't see the volatility we've seen in March.
What has got to happen for you to take off your overweight hedges on the market, such as treasuries, gold and FX?
To be frank, on the long term, we are still in a recession. So the thing is, the market is still going to react to this fundamental. And until we have more visibility on what will be the curve of the rebound, how long will it take to rebound? And I think now everybody has understood that it will be not a quick rebound. We saw in China that even though there is some fiscal stimulus and output in industrials is going up, retail sales and consumer are not coming back to the market like before. So I think it will be, the trigger will be to understand how long will the recession last and how will be the recovery.